Welcome to the Deep Dive. Today we're digging into the recent Box Inc. first quarter results for their fiscal year 2026.
That's right, they just had their earnings call.
And the overall tone seemed pretty positive, didn't it? They reported a strong start to the year, lots of momentum, especially with some of their newer stuff.
Absolutely. Though, they did acknowledge the broader economic picture still has some uncertainty.
Of course. But let's start with the numbers. What were the key takeaways from Q1?
Yeah, so looking at the highlights for Q1 FY26, they basically beat expectations on, well, pretty much everything.
Okay, nice. Give us the headline figures then.
All right. Revenue landed at $276 million. That's up 4% compared to last year, or 5% if you strip out the currency fluctuations, constant currency.
Got it. And profitability.
Operating margin came in quite healthy, 25.3%, and their non-GAAP EPS, earnings per share, was $0.30.
The 30 cents. And that beat their guidance.
Yeah, by 4 cents. So pretty decent beat there.
That's definitely a positive sign. What about the indicators looking forward, like RPO and billings?
Right. Remaining performance obligations, RPO, that's basically signed contracts not yet booked as revenue, hit $1.5 billion.
Wow, $1.5 billion.
Yep. That's a solid 21% jump year over year, or 17% in constant currency.
And billings, I heard that was particularly strong.
It was. $242 million, grew 27% year over year, or 17% constant currency. And yeah, management specifically called that out as being better than they expected.
So across the board, they beat their own targets for the quarter.
Exactly. They surpassed all their key guidance metrics.
Impressive start. Okay, let's dive a bit deeper. Revenue growth was solid, 4 or 5%. But that RPO growth, 21%, that sounds pretty significant. What's driving that big jump?
You got it. The strength in RPO, especially the longer term portion of it, was mainly because customers are signing up for longer contract durations.
Okay, so deeper commitments.
Seems like it. It suggests customers are embedding Box more deeply into their operations.
Makes sense. And that billings number, 27% growth year over year. That's a big leap. What was behind that outperformance?
Well, it came from a couple of things. First, just strong overall bookings, good sales execution.
Okay.
But there was also a noticeable tailwind, you could call it, from customers renewing their contracts early.
Early renewals. How much did that contribute?
That added about 400 basis points, so 4 percentage points, roughly $7 million just to the Q1 number.
Okay, so specific bump in Q1. Anything else?
Yeah, currency helped too. Favorable foreign exchange rates gave them about a 700 basis point boost compared to what they were previously anticipating.
Right. So strong underlying performance plus those two tailwinds. That paints a clearer picture of the 27%. How about customer retention, keeping folks on board?
Yeah, net retention rate ticked up slightly. It went to 102% in Q1, up from 101% a year ago. Pretty much where they expected it.
And churn?
Stable, remained at 3%. So yeah, the platform looks pretty sticky.
Good to hear. Let's switch to profitability margins. Gross margin was just over 80%.
Yeah, 80.5%. That's up about 30 basis points year over year.
Okay.
But it's worth remembering, in Q1 last year, they actually had a bit of a one-off benefit, about 100 basis points, from selling some data center equipment.
Right. So the underlying margin improvement was actually stronger than it looks.
Exactly. If you factor that out, the core improvement is better.
And operating margin, that was 25.3%. Looks slightly down year over year.
It did, from 26.6%. But again, there are adjustments. If you account for last year's equipment sale impact, the extra day from the leap year, this Q1, and FX effects.
Okay.
The underlying operating margin actually shows about a 90 basis point improvement year over year.
Got it. So important context there on the operational efficiency. We mentioned the EPS beat earlier, but didn't they call out some specific non-cash items affecting that $1.30 number?
They did. That $1.30 included a small 1 cent benefit from favorable FX rates.
Right.
But a more significant impact was a 12-cent hit from non-cash deferred tax expenses.
12 cents.
Oh.
Okay, good to know. Moving on to the financials. Cash flow. Balance sheet strength.
Looked pretty healthy. Free cash flow for Q1 was strong at $118 million.
Nice.
Cash flow from operations was $127 million. And they ended the quarter with a good cash pile, $792 million.
And returning cash to shareholders.
Yep, they were active there too. Bought back about 1.6 million shares for around $50 million.
Okay.
And they still have authorization left, about $152 million remaining for future buybacks.
All right. Solid financial footing. Let's pivot now from the pure numbers to the strategy behind this momentum. Management really hammered home that this strong start to FY26 was fueled by demand for Box AI and early wins with their new Enterprise Advance offering.
That's definitely the narrative. The traction they're getting with Enterprise Advance, which only launched last quarter, seems key, especially, as companies everywhere are trying to figure out how to actually use AI with all their documents and unstructured content.
Right. Can you give us a feel for how customers are actually using Enterprise Advance? They shared some examples, didn't they?
They did, and they're pretty illustrative. One was a big university hospital. They upgraded significantly to Enterprise Advance and bought a lot more Box seats. Their main goal, get all their scattered content into Box as a single source of truth.
Makes sense.
And then use Box apps and AI features, like automatically extracting metadata from documents to unlock more value.
Interesting. Any others?
Yeah, another one was an investment advisory firm. They were already using Box's AI API, but they upgraded to Enterprise Advance specifically for the Box AI Studio.
What does that let them do?
It lets them play around with different AI models easily, and they plan to use Box apps like dashboards and Box Doc to streamline their operations.
Okay. And they mentioned a new customer win, too.
Right, a financial services firm, a completely new customer buying Enterprise Advance right out of the gate. They were moving off an old on-prem system.
Modernization play.
Exactly.
Yeah.
Focus was on better security, user experience, and improving processes like loan origination, HR, legal stuff.
So these examples show it's not just about features, but solving specific business problems, often tied to AI and content. Management also talk a lot about this bigger shift towards an AI-first world.
Yes, that was a major theme. They pointed to their own survey over 1,300 IT leaders. More than half expect AI to really transform their business in just the next 2 years.
Wow.
And nearly 90% are already using AI agents somehow. The key bit for Box, though, is that the top things these leaders want AI for involve working with documents and unstructured data.
And that's Box's sweet spot, right? That's the opportunity they see.
Precisely. This whole AI agent thing, it unlocks the potential to finally get value out of all that enterprise content that was previously just sitting there, too hard for humans to process at scale.
Like finding new product ideas or optimizing supply chains.
Exactly. Analyzing contracts, customer feedback, research papers, things that were just too time-consuming before. AI agents are the key, in their view.
So Box is positioning itself as the platform for that, the intelligent content management platform. They just had a Content Plus AI summit, right?
Yeah.
What came out of that related to these AI agents?
Yeah, they rolled out some pretty big updates focused on letting AI agents do deep research, better search, better data extraction.
And crucially, doing it securely within Box.
That was the heavy emphasis. Security, but also openness and interoperability. Letting these agents work across all sorts of unstructured data contracts, research marketing stuff to automate workflows and pull out insights.
What kind of complex stuff could this actually enable? Did they give examples?
They did. Things like speeding up M&A due diligence by having AI analyze thousands of documents.
Okay.
Or correlating customer trends from, say, survey responses and research reports, or even accelerating analysis of life sciences and medical research for drug discovery.
That sounds powerful. What's changed in the AI world to make this feasible now?
It's kind of a convergence of factors. One is that the cost of actually running these AI models, inference costs, is dropping. Plus, the models themselves are getting better. They can handle more data at once, bigger context windows. Their reasoning ability is improving.
So they can tackle more complex tasks.
Exactly. And we're getting better at designing these agentic workflows where you have multiple AI agents collaborating on a bigger task.
Interesting. They also mentioned AI agents working together across different platforms, not just inside Box.
Yes, that's core to their vision. They don't see Box as an island. The idea is that AI agents working with Box content should be able to interact with an enterprise's entire AI setup.
So integrations are key.
Absolutely. They listed a whole bunch, either available now or coming soon. Integrations with Microsoft 365 Copilot, IBM Watson X, Google Agent Space, Salesforce Agentforce, Slack AI, ServiceNow, Zoom AI.
Wow, basically all the major players.
Pretty much. Plus developer options for building custom agents.
And that recent ChatGPT integration they highlighted.
Yeah, that seems significant. ChatGPT can now officially use Box as a secure, connected data source for its deep research AI agent.
What's the benefit there for users?
Flexibility, basically. You can work in the AI tool you like, ChatGPT in this case, and the AI agents handle accessing the right data securely from Box in the background. They see this as the future model for how software works with AI.
And Box's position on the underlying AI models themselves seems important here, staying neutral.
Very important. Strategically, they keep emphasizing that customers can choose any AI model provider they want.
Why is that an advantage?
They frame it as giving customers instant access to the best, latest AI tech for their specific content, rather than being locked into whatever model one vendor provides. And they pointed to partner momentum just in Q1 as proof this is resonating.
Like what?
Being mentioned by NVIDIA's CEO at GTC, being an OpenAI agent SDK launch partner, Meta showcasing Box with IBM's Llama model, being an XAI Grok 3 API launch partner. They expect more of this.
It sounds like they're really embedding themselves in the ecosystem. And looking ahead, September seems like a key date.
It does. They teased their BoxWorks event in September, saying it will feature their biggest and most exciting announcements ever. So clearly framing this year as the big year for AI agents and AI-powered workflow automation on their platform.
Okay, shifting gears slightly to sales and go-to-market. They talked about continued momentum for Enterprise Advance and driving price increases.
Yeah, they're seeing EA adoption pick up across different customer sizes and geographies. That's building a strong pipeline. And they said it's largely driven by these AI use cases we've been discussing.
And they're getting the price uplift they wanted.
Seems so. They're hitting their target range of a 20-40% price increase for those Enterprise Advanced deals.
And partners are helping drive wins too. System integrators.
Definitely. They highlighted solid momentum from partner-led wins, gave an example with a company called DataBank, helping a local government replace an old ECM system.
ECM being Enterprise Content Management.
Right. And also mentioned Regional S helping financial services and life sciences firms automate processes and replace legacy systems, especially in regulated areas.
Speaking of regulated, they got a big authorization this quarter, right? FedRAMP High.
Yes, that's a critical one. FedRAMP High authorization. It basically opens the door for U.S. government agencies and contractors to use Box for highly sensitive data. Big deal for that vertical.
And finally, they talked about their own internal efforts becoming an AI-first company.
Yeah, they're really trying to practice what they preach. Using Box AI internally, being customer zero, as they put it.
Why? Just to eat their own dog food?
Partly that, yes. Improve their own speed and decision-making, automate workflows internally, but also, crucially, to gain firsthand experience, figure out best practices, and refine the AI platform based on their own usage. Sort of living in the future, as they said.
What kind of things are they using AI for internally?
A whole range. Getting quick answers for customer support, speeding up sales onboarding, answering HR questions for employees, helping review code, generating content.
And building custom agents, too. Custom AI agents for things like drafting call scripts, creating personalized sales materials, generating first drafts of RFP responses, extracting metadata for compliance. They're really pushing it across the board, adopting AI-first tools for coding and customer service, training everyone, upskilling, and even looking for AI skills in new hires.
It really sounds like they see AI as fundamentally changing how work gets done, and they want to be at the heart of it.
That's the clear message, both for their customers and inside their own walls.
Okay, let's tie this all together. From an investor perspective, what are the key takeaways from these results and all this commentary? What does it mean for the investment thesis?
Well, one really crucial dynamic to understand is how they're driving customer expansion right now.
Okay.
Management was pretty clear that growth in the actual number of seats a customer buys is, well, a pretty minor contributor at the moment. And that part is more sensitive to the macro environment.
So seat growth isn't the main story. Not right now. The primary engine for expansion is pricing improvement, specifically those upsells to Enterprise Advance, where they're getting that 20-40% price bump. That's the main growth driver within existing customers today.
Okay, that makes sense, especially given the EA momentum. Now, speaking of financials, there's some discussion about billings, the timing within the year or linearity, and how that affected the full year guide in constant currency. Can you unpack that?
Right. So Q1 billings were strong, partly because of that roughly $7 million tailwind from early renewals we talked about.
Yeah.
Think of it this way. Some deals that might normally have closed and been billed in Q2 actually landed early in Q1.
Okay, pulled forward.
Exactly. That boosts Q1, but means that revenue shifts out of Q2. So when you look at the growth rate from Q1 to Q2 sequentially, it might look kind of flat or maybe even dip a bit.
Even though the overall performance is good.
Right. The overall first half of the year is tracking pretty consistently with what they originally expected before they decided to bake in a bit more caution for the second half due to the macro outlook.
So the full-year constant currency billings guide, which implies maybe a slight downtick from what they might have thought earlier, it's mostly about being prudent about the second half.
Precisely. That little bit of trimming on the full-year constant currency billings outlook is specifically attributed to building in that extra conservatism for H2 because of the ongoing macroeconomic uncertainty. That's despite the strong Q1 and the momentum they're seeing right now.
Got it. How should we think about the costs of all this AI stuff they're adding? Is it going to kill their margins?
Well, their stated goal is for the AI functionality to be roughly margin neutral in the medium term.
Margin neutral? How?
Their bet is that the cost of actually running the AI models, the inference costs, will keep coming down over time. And that decrease will help offset the cost of adding all these new sophisticated AI capabilities.
Okay. And how do customers actually pay for AI?
There are multiple paths. Some basic AI features are just included in the standard business plans now. More advanced stuff requires that upsell to Enterprise Advance. And then for really complex or high-volume AI use cases, there's the potential for customers to pay based on AI unit consumption, basically, paying for how many AI tasks or queries they run.
Right. That opportunity to replace older ECM systems came up again. That seems like a big deal in an AI context.
Definitely a major angle. Box sees customers increasingly willing to ditch those old clunky enterprise content management systems that just weren't built for AI workflows.
And partners help with that transition.
Yeah, those system integrator partnerships are key. Sees can handle the heavy lifting of migrating customers from legacy on-prem setups to a modern cloud platform like Box.
And what about their overall strategic position in the AI world?
They really believe their core strength as a content platform, plus that neutrality on AI models, partnering with Google, OpenAI, IBM, Meta, etc., puts them right in the middle of the ecosystem.
And that helps bring in business.
Apparently so. They said that multi-partner approach boosts their visibility and is directly driving pipeline. In fact, they stated the vast majority of the pipeline for Enterprise Advance is coming from customers specifically looking for AI-driven use cases.
That connects to their strength in regulated industries, right? Healthcare, finance, government. Applying AI there must be tricky.
Absolutely critical. Think about it. Life sciences, banking, public sector, healthcare, they handle incredibly sensitive data. You can't just let any AI loose on that.
Right.
Security and compliance are paramount. As their CTO put it, AI agents can't keep a secret on their own. You have to manage security at the data access layer, controlling what the AI sees and who can ask it.
And Box's platform is built for that.
That's their argument. Built with granular security and compliance from the ground up, making them, they believe, a natural fit for these high-value, high-stakes enterprise AI jobs where data control is everything.
What about the federal space specifically with that new FedRAMP High status?
They still describe the federal market as dynamic, maybe some caution there. But getting FedRAMP High is expected to be a significant boost. It lets them go after highly sensitive use cases within the U.S. government, potentially even agencies like the Department of Defense.
Okay. And lastly, on revenue streams.
Yeah.
That AI unit consumption model, where does that stand? Is it generating much yet?
Very early days is the message. Still quite lumpy. The use cases tend to be around things like AI-powered data extraction and parsing information from complex documents or images.
And how do they monetize that?
It's kind of layered. It's partly covered by the existing seat licenses, but there's potential for additional charges based on AI unit volume, how many queries or tasks you run.
Does it matter if the AI task starts in Box or somewhere else?
No, and that's key. It applies whether the AI is triggered directly in Box or via an integrated third-party agent, like from Salesforce, Google, IBM, whoever. They keep stressing that openness and interoperability is the long-term strategic play here.
Got it. They also flagged something about taxes hitting the full-year EPS guide.
Yeah, non-cash item. They expect deferred tax expenses to create an incremental headwind of about 7.22 cents to their non-GAAP EPS for the full fiscal year.
52 cents.
Yeah.
Okay. Before we move to our next segment, could you quickly run through the updated guidance numbers for Q2 and the full year?
Sure. For Q2, they're guiding revenue between $290 and $291 million. That's about 8% growth year over year, or 6% constant currency.
Okay.
Billings in Q2 are expected to be roughly flat year over year. That reflects that early renewal shift we talked about, plus some FX impact. Gross margin around 81%, operating margin near 28%, and EPS between $0.30 and $7.31.
And for the full fiscal year 26?
They nudged up revenue guidance slightly to $1.165 billion to $1.17 billion. That's up about $10 million from before, roughly flat in constant currency terms, representing about 7% growth year over year, or 6% constant currency, including a nice FX tailwind.
Okay. Billings.
Total billings growth for the year expected around 9%, and that includes a pretty significant 340 basis point FX tailwind. Gross margin still guided around 81%, operating margin around 28%.
And EPS?
Full year non-GAAP EPS projected at $1.22 to $1.66. That's up about 9 cents from their prior guide, or 2 cents in constant currency. And importantly, that range includes both that 0.52 non-cash tax headwind and a 7-cent FX tailwind.
And they stress prudence in that outlook.
Yes, definitely emphasize that caution, especially for the back half, is baked into those numbers.
All right, great summary. Now let's shift gears to our not financial advice segment. Just a reminder, everything we've discussed so far is based on the earnings call materials. This next bit is purely illustrative. It's designed to spark ideas, not provide investment recommendations.
Exactly. Think of this as a creative exercise based on the themes we just explored. Definitely not advice.
Okay, so based on this deep dive into Box, here's an outrageous but plausible trade idea for you to consider. How about a pairs trade? Betting on Box's specific ability to win in those highly regulated, data-sensitive AI scenarios, relative to a competitor you think might be less prepared or slower moving in that critical niche.
Yeah, the logic ties right back to what we were just saying. You've got Box getting FedRAMP high. You've got their established footprint in healthcare, finance, government industries obsessed with compliance.
Right.
And you have their constant drumbeat about security being foundational for AI on content that AI agents can't keep a secret point. It really suggests they're well positioned for those high-value, super sticky enterprise AI deals where controlling data access is absolutely paramount.
So you can contrast that with maybe another platform, perhaps one whose architecture or AI strategy seems more focused on, say, open data access, without the same level of deep, granular security controls designed specifically for sensitive content.
Right. An approach like that might just be less suitable or perceived as less suitable for applying AI to things like protected health information, financial records, classified government data, PII, you name it.
So how would this theoretical trade work?
Well, the idea would be go long Box stock, buy it, betting on their strength in this regulated AI niche, and simultaneously go short sell the stock of a comparable competitor that you believe is potentially weaker on regulated compliance or lacks that enterprise-grade security focus for AI on sensitive content.
Okay, interesting thought experiment. But again, purely illustrative, absolutely not financial advice. Please, always consult a qualified professional before making any investment decisions.
Definitely. So just to wrap up the main takeaways from the quarter then, Box delivered strong financials, beat their own guidance. They showed real tangible momentum with Enterprise Advance and Box AI right out of the gate.
Suggesting their core strategy is getting traction.
Exactly. Their positioning in the AI ecosystem, neutral, partner-friendly, security-focused, looks like a deliberate, potentially very smart strategy. And they're clearly committed to improving financials while still investing heavily in these growth areas.
And remember, this whole conversation has been our summary of the earnings call, just for informational purposes.
Right. And maybe leave you with this final thought to chew on. As AI becomes more embedded in business, how critical will that need for secure, compliant content management become? That idea that AI agents can't keep a secret, could that fundamentally change who wins and loses in the enterprise AI race? Maybe favoring platforms where security isn't an add-on, but part of the foundation?
Definitely something to watch as this all unfolds.